The moment you realize that the foundation of the global financial system might be shifting beneath your feet, it's already too late. What if the world's most powerful currency is slowly being cornered? Not by war, not by sanctions, but by thousands of tons of gold quietly locked away in vaults across China? And what if this isn't just accumulation, but preparation? For decades, the US dollar has ruled the global economy. It dominates international trade, energy pricing, global reserves, and cross-border payments. Roughly 58 to 60% of global foreign exchange reserves are still held in dollars, according to IMF data. That dominance has allowed the United States extraordinary influence over global finance. But power in monetary systems doesn't collapse overnight. It erodes slowly, and China appears to understand that better than anyone. China has been steadily increasing its official gold reserves. The People, the S Bank of China, resumed reporting consistent monthly gold purchases starting in late 2022, and has continued buying through 2023, 2024, and into 2025. Official holdings now exceed 2,200 tons. Yet multiple analysts believe the true figure may be significantly higher, potentially routed through state banks and undisclosed channels before being added to official reserves. If that's true, then what we see publicly may only be a fraction of the real strategy. But here's the real question. Why gold? And why now? Gold is not someone else's liability. It cannot be printed. It cannot be frozen digitally. It does not depend on the creditworthiness of a government. When Russia's foreign reserves were frozen in 2022, the message to the world was clear. Reserves held in foreign currencies can be weaponized. For China, a geopolitical rival of the United States, that event was likely a financial wake-up call. If access to dollar reserves can be restricted, then building reserves outside the dollar system becomes a matter of national security. And this is where things get more interesting. China is not only buying gold, it is also building alternative financial infrastructure. The Cross-Border Interbank Payment System, CIPS, provides an alternative to SWIFT for yuan settlements. China has signed currency swap agreements with dozens of countries. It has pushed for yuan-based oil trade with certain partners. If trade begins settling more frequently in yuan, or in contracts linked indirectly to gold, the demand for dollar reserves could slowly decline. Now imagine a scenario where gold backs confidence in the yuan during times of crisis. Not a formal gold standard, but a psychological one. If global markets believe China holds massive gold reserves, that perception alone strengthens trust in its currency. Trust is the core of monetary power, and trust backed by hard assets is historically powerful. But here's the tension that keeps analysts divided. The dollar remains deeply entrenched. U.S. Treasury markets are the most liquid in the world. Global commodities are still primarily priced in dollars. Most central banks continue to hold large portions of their reserves in dollar assets because of stability and convertibility. Replacing that system would require enormous structural change. So is China really trying to dethrone the dollar, or simply insulate itself from it? That's the curiosity most people miss. China does not need to destroy the dollar. In fact, a sudden dollar collapse would damage China's own export-driven economy. What it may want instead is optionality, the ability to operate outside the dollar system if necessary. Gold provides that option. Gold is neutral. Gold is universally accepted. Gold doesn't care about sanctions. Meanwhile, global central bank gold purchases have surged to record levels in recent years. According to the World Gold Council, central banks collectively bought over 1,000 tons of gold in multiple recent years, the highest pace in decades. China has been among the most consistent buyers. This suggests the trend isn't isolated, it's systemic. If central banks are shifting from debt-based reserves toward tangible assets, what does that signal about long-term confidence in fiat systems? And here's where it becomes strategic. China is the world's largest gold producer. It also imports massive quantities through Hong Kong and other channels. Much of that gold never leaves the country. When a nation both produces and accumulates gold at scale, it strengthens internal reserves while reducing reliance on external supply chains. That's not accidental, that's structural positioning. Think about this carefully. If over the next decade, more global trade is conducted in yuan, if more bilateral agreements bypass the dollar, if more central banks increase gold allocations, then the dollar's share of global reserves doesn't need to collapse to lose influence. It only needs to shrink gradually. Even a 10-15% shift in global reserve composition would represent trillions of dollars moving out of dollar-denominated assets. And what happens to U.S. borrowing costs if global demand for treasuries declines? What happens to global liquidity if dollar dominance weakens? These are not small questions. These are system-level consequences. Yet there's another layer most people ignore. China's strategy is patient. It works in decades, not election cycles. While Western markets react to quarterly earnings and rate decisions, China's monetary planners are thinking generationally. Gold fits that mindset. It is slow, heavy, and strategic. It doesn't spike because of hype. It accumulates power through scarcity. But don't mistake this for inevitability. The dollar still benefits from deep institutional trust, legal transparency, and unmatched capital market depth. Investors around the world still run toward the dollar during crises. That behavior hasn't changed. For China to truly challenge dollar supremacy, global investors would need to view Chinese financial markets with the same level of confidence, and that trust is not yet fully established. So what are we really witnessing? Not an immediate dethroning, but a repositioning. A hedge, a preparation phase. China's gold hoard is like an insurance policy against a dollar-centric world that may not always favor Beijing. It strengthens negotiation power. It reduces vulnerability. It signals financial independence. And in geopolitics, signaling matters. Now bring this back to investors. If central banks are accumulating gold at historic levels, if geopolitical fragmentation is accelerating, if alternative payment systems are expanding, then gold may not just be an inflation hedge. It may be a geopolitical hedge, and that changes how markets price it long term. The real twist is this: the shift doesn't have to be dramatic to be historic. Monetary dominance rarely ends with explosions. It fades through diversification, through quiet reserve adjustments, through subtle trade agreements, through vaults filling up one bar at a time. And by the time the shift becomes obvious, positioning opportunities may already be gone. So is China executing a secret plan to dethrone the US dollar? The evidence suggests it is at least building the capacity to operate without it. Its gold accumulation, alternative payment systems, yuan trade expansion, and long-term reserve diversification all point in one direction: resilience and optional power. Whether that evolves into a full challenge to the dollar depends on global trust, economic reforms, and geopolitical stability. But one thing is clear: gold is no longer just a relic of the past. It is re-entering the center of global monetary strategy. If the dollar remains dominant, China's gold still protects it. If the dollar weakens, China's gold strengthens it. Either way, the strategy carries asymmetric advantage. And that's what makes this story powerful. The world may not wake up to headlines declaring the dollar dethroned. Instead, one day, analysts may look at reserve data, trade flows, and gold allocations, and quietly realize that the balance of monetary power has already shifted. Not with noise, not with collapse, but with gold.